Baillie Gifford continues to focus on ensuring our people are safe and on looking after our clients and their portfolios. Our thoughts are with everyone affected during this time. We're all well on the US equity team, and thanks to the firm's significant investment in technology and connectivity over the years, the day-to-day management of the portfolio remains unaffected. It's during challenging times that sticking to our investment philosophy and process really matters. Our long-term, team-based approach and Baillie Gifford's supportive culture protects us from many of the stresses surrounding investing during a crisis. Given current conditions, we're pursuing 3 forms of monitoring. Firstly, we conducted a detailed examination of the financial resilience of the portfolio's holdings in March. In aggregate, it scores well. The portfolio has a net cash position against a market debt-to-equity ratio of 57%. However, companies must first survive before they can prosper. So we've re-examined the financial stability and balance sheet strength of all holdings and analysed their ability to adapt their cost bases, as well as considering the strength of their suppliers and their customers. And we've done this for both listed and unlisted holdings in the trust. The outcome of this initial review is that we're confident the portfolio is well positioned to weather ongoing uncertainty. We've not taken any immediate action as a result of this work, but it forms a baseline for monitoring. Our second avenue of exploration is a review of our forward-looking hypotheses for holdings where we think the arguments might have shifted recently. And finally, we're working on new opportunities. When this crisis passes, the world we return to may not be the one that we left. We believe we're invested on the right side of creative disruption driven by technological progress. The future of commerce powered by the internet, transformation of healthcare treatments, and the battle for our leisure time attention are key themes. The current situation may well increase the pace of disruption. Technologies and companies that reduce friction, allow us to continue consuming, and businesses to function will be more highly prized. While it's still early to draw strong conclusions about long-term changes caused by the pandemic, we've started to look for opportunities that have arisen due to extreme volatility, and we're establishing a framework for analysing areas of potential further disruption to traditional behaviours that are now unwinding. Foremost in our minds is enterprise software. We feel that this crisis will accelerate the shift towards cloud computing, and that the digitization of businesses will drive growth for many years. There are several companies with strong competitive positions. In the first instance, we've taken a holding in Workday, the cloud-based enterprise resource planning software provider. To fund the purchase of Workday, we've sold Danaher spin-off Fortive, an industrial conglomerate, and education company 2U. Muted organic growth and questions over competitive advantage were key issues for both these companies. Now more than ever, we urge clients not to place much emphasis on our performance over short periods. Our focus is on the next 5 years and beyond, but we understand the desire for current information. The fund has held up well over this very short period year to date. Exposure towards technology and the new economy and away from industrial cyclicals has helped. In previous crises, great structural growth companies have often deepened their advantages within a downturn and accelerated out of it. Demand for online services has exploded as large parts of the world have gone into lockdown. The large online platforms are demonstrating their resilience and are increasingly viewed as vital utilities. A number of the companies in the portfolio have fared well, either because they directly contribute to immediate healthcare needs or research into a cure, such as Moderna and Amazon, or because they enable us to stay connected, entertained, or continue to consume in a world in lockdown. For example, Zoom video communications and Netflix. In contrast, Holdings such as Wayfair, the online home furnishings company, and Stitch Fix, the online personal styling service, were hit hard during the sell-off in March. The market assumed that any company exposed to discretionary consumer spending would be impacted by a dramatic reduction in demand and disrupted supply chains. However, in the short term, for Wayfair at least, social distancing restrictions may actually increase demand for purchasing furniture online and potentially change consumer behavior in the long run. Now more than ever, we believe our calm and patient long-term approach is the best way to ensure the portfolio emerges from this crisis at least as robust as it entered it. We think that many of the companies in the portfolio have important roles to play during and after the pandemic, and it's well positioned for long-term growth. We encourage you to read our paper on how the pandemic may change things on our website when you get a chance. We would like to thank investors for your continued support, and we hope that you and your families remain healthy.